Here we go. So learning objective 2 is the meat and potato. I keep saying that. I don't know, maybe I'm hungry. I actually did not have dinner yet, so maybe I am hungry a little bit. And it really looks at, and you're going to be introduced to the inventory cost flow methods. And this is really where you're going to spend most of your time in this chapter, is right on this learning objective. So like I was saying in our conversation earlier, you go into a store and they're always buying inventory and putting it on the shelf. And every time they buy inventory, I mean, they probably are not paying the same price for the inventory that they're buying. Inventory changes prices every time they go out and buy more stuff. So customers walk in and buy that stuff and they have to ring up the revenue, but they have to subtract the cost of goods sold. Well, the question is, I just bought all this stuff at different prices. Which one did I just sell? Right. That's what the inventory cost flow methods will help businesses answer. It answers that question, right? And so basically speaking, remember, when they buy the inventory, they record it at the cost, right? But and that means that they are keeping track of the costs of all their inventory. When they actually sell it, this is the exact same cost that they used for cost of goods sold. So how they determine that is what you're going to be learning. We basically are going to be focusing on the bottom. These are the most common cost flow assumptions. The fourth one that's listed here is called specific identification. And without specifically identifying it, I will say that basically speaking, it's not used widely enough to really cover in detail, particularly for this type of course. If you were all like, going to be, you're studying for your CPA exam, certainly we would go into a lot of detail. But in this case, we're trying to get ideas started, basics started, so you can flow. So that means we have to introduce you to the most common cost flow assumptions, and they are listed here. The first one is called first in, first out, and it goes by FIFO. And that's the first one we're going to be learning. So that's the first one in, first one out. You remember Jack and the Beanstalk, right? He went up the beanstalk and he was, I guess there was a giant up there, living in a castle, I suppose. It's kind of an odd story. But nonetheless, the giant went fee, fi, fo, fo. Actually, he was an accountant, like fee, fi, fo, it's FIFO, it's FIFO. He was talking about this inventory method. Do you believe me? The next one is last in, first out, what we call the LIFO method. Okay, it's also what a lot of accountants tell their kids, get a LIFO. But this one, you're going to learn the last inventory that comes in is the first inventory that we sell. Just the opposite of first in, first out. The first inventory coming in is the first inventory we sell out. That's how we see it. That's how we see it with the cost method. And the last one you're going to learn about is average cost, which is we just spent a ton of money on inventory. We bought these many units. That's the average of unit was X. That's easy. You're going to spend most of your time figuring out LIFO, FIFO. So let's get going. Your book does go into and explains a little bit of specific ID. Again, we don't cover it here. It will be covered in more advanced accounting classes for sure. So the cost flow assumptions came in. FIFO is the most popular method of costing out inventory. Okay, used by businesses. I don't know when this particular chart was created. Probably in the last 10 years for sure. But I would say it's just less than half of companies use FIFO. Another huge chunk of companies use the LIFO method. Okay, so between these two methods, that's almost 3/4 of everything that you're doing. As you see, average cost is in a distant third, as are the other. So let's take a look at what we're looking at. Before you can do any cost flow assumption, You have to have a list of inventory in front of you. If you do not have a list of inventory in front of you to look at, this makes no sense whatsoever. Okay. Um, so this particular data is critical before we can even start. Okay. So this is the company Houston Electronics. They have a product that's called an astro condenser. I'm sure it's a play on words. I don't know what one of those things are. And this is the inventory of the astro condensers at the beginning of the year. I guess they use a calendar year. They have beginning inventory. So they have 100 of these astro condensers already in inventory. They paid $10 each for those astro condensers. So they actually start the year with $1,000 of inventory. Okay. So the beginning inventory is the $1,000 of inventory, which is 100 units of these astro condensers. The next thing you'll see is that in April, in August, and in November, they went out and purchased a whole bunch of astro condensers, a little at a time. In April, they purchased 200 astro condensers, but the cost to that business went up from 10 to 11. So now they paid $11 each for these astro condensers. So they added $2,200 of cost to their astro condenser inventory. In August, they bought 300 more, and see again, the cost increased to $12 per astro condenser. So they just forked out $3,600 in August for more of these things. And in November, they went big. They brought in 400 more of these astro condensers. I guess it makes us a nice stocking stuffer for those families down in Houston at $13 per unit. And so they spent another $5,200 on inventory. So in total, they bought 1,000 astro condenser units for $12,000. Okay, this is how you got to start. You got to read that far. Okay, and it is like anything else, line by line by line. Take your time with this. So the beginning inventory plus the purchases. Beginning inventory plus the purchases. $12,000 worth of inventory. Total available inventory for sale was 1,000 units or $12,000 worth of astro condensers. Okay. Only two things can happen to the inventory. You either still have it, thus ending inventory, and if it's not there, we assumed it's sold. So of these 1,000 astro condenser units, we still have 450 of them in the store. We still own that. That's our ending inventory. That's our asset. We sold 550 of them. The question that the cost flow assumptions answer is, which 550 did we sell? And which 450 are still in the store? Okay, so let's apply them. FIFO, the FIFO method, means the first ones on the list. That first in is looking at the top of the list. The first ones on that list are the first ones we sold. That's the out part. Okay. And so of the ones that we sold, if the company uses a FIFO method, those top ones are sold first. And that's how they determine their cost of goods sold. And of course, whatever is left in the store is their inventory. So let's see how it plays out if the company uses first in, first out. Again, everything starts with an inventory list. Otherwise, none of this makes sense. So as you know, these 1,000 units were all purchased and available for sale. You also understand that under FIFO, the first ones on the list, means the ones from starting with January 1st, have been sold. Okay, have been sold. So if you sold 550 units, you sold these 100 as part of it. You sold these 200 as part of it. and you sold 150 of those as part of your sales that year. So I'm sorry, 250 of those as part of your sales that year. So 100 plus 200 plus 250 is 550. Those are the ones that you sold. What's in your store? Your book asks you to determine what's in your store. Well, 50 of these puppies are still in your store, and all 400 of these are still in your store. So the value of your inventory is the 50 at 12, right, is $600, plus the 400 at 13, which is 50 turnovers. So you have in the store, you still have $5,800 worth of inventory. Remember, you started with the 12,000, you still have 5,800. The difference clearly isn't there, it's what you sold. So the difference is the cost of goods sold. But again, this is how your book explains it. You can double check mathematically that this is correct. How do we know that this is the correct number for cost of goods sold using FIFO? Well, we can check it. 100 units have been sold at 1,000. These 200 units were sold 2,200. So we're already at $3,200. Right? 250 units were sold at 12 bucks, which is another $3,000. So 1,000 plus 2,200 plus $3,000 gives you the 6,200. So you can check it that way. Okay. So again, FIFO, you look at the list, the first ones in have been sold, which means they're part of cost of goods sold. This number down here. The ones that are still in the store are inventory. They would be from the bottom of the list. Okay. After you've crossed out all the ones that have been sold, the left or the rest is the ones on the bottom. So this is how it looks in a graphic form, and I love this. This is a beautiful illustration. I have this one in my hallway. It's very, very beautiful. As you see here, each of these blocks represents, so this is the beginning inventory, that's the April purchase, that's your August purchase, that's your November purchase, right? And then it broke it up into the parts. Which ones were sold? Well, the first ones in are the first ones out. Those are the ones that were sold. All 100 of those, all 200 of those, and 250 of the 300 of those, and that's their cost. What's left in the store is your ending inventory. Again, ending inventory, asset, going to be in your balance sheet. So everything from, 50 of those units from August are still with you, and all 400 units from November are still with you. So that's basically the graphic form. I don't like to be very graphic of how this is done. LIFO is the last one in, is the first one that we sell, first one out. So the last one in is that's from the bottom of the list of purchases. We assume the bottom of that list of purchases, that's the first ones we sold. So that's how we calculate it with LIFO. Okay. So let's see how that goes. Again, we have to have an inventory list, otherwise none of this stuff makes any sense whatsoever. LIFO, again, we have the list. LIFO, the last ones in. So we're starting with the last ones on the list, which is these 400 units from November. The last ones in, these are the ones that have been sold. So we sold 550. That goes back to that first slide. So which ones did we sell? All of these are sold, and half of these are sold. 400 plus 150 is 550, right? So which ones are still in the store? Well, the other 150 of these are still in the store, plus these 200, plus those 100. That's 450. So 100 at $10, 200 at $11, and 150 from August at $12. We have $5,000 worth of merchandise in the store, these particular units. We started with $12,000 of these Astro condensers. We now have 5,000 left still in inventory, which means we sold the rest, 7,000. You can check that number. Cost of goods sold can be checked using LIFO, right? Last one's in, so these 400 have been sold. That's $5,200. these 400. Half of these have been sold. That's 1,800, 1,800, and 5,200, 7,000. It works out. Fascinating stuff, I know. Last in, first out. This is another beautiful picture. I have this in my living room. Okay. And this one here again depicts it graphically. I hate to get so graphic here, but this is our beginning inventory. This is our April purchase amount. This is our August purchase amount. This is our November. LIFO means the last ones in are the first ones sold. That's why they're on the truck. They're sold. So all of this has been sold and half of this lot has been sold. That's where we get the 7,000. All of these are still in the store. Remember, inventory, asset account, balance sheet, cost of goods sold, expense account, income statement. That's why it's important that we use these so we have accurate records. We know exactly what is what. The last one is in some cases the easier one to do because we're simply doing an average. Okay. And we will get to, I will give you examples of companies that use what. So I will get to Hope's question in a moment. So average cost basically totals up all the money we spent on, in this case, astro condensers, and divides it into how many astro condensers we bought with that money. And that's your average cost of the astro condenser. Okay. And then that's the number you use to calculate. So again, in this case, we're using the list a little bit differently because we're using these two numbers. We have $12,000 worth of astro condensers, and that bought 1,000 astro condensers this year. So each unit was worth 12 bucks. So if you have 450 units still in the store, they're all valued at 12 bucks. So 450 times 12, you have $5,400 of inventory in the store. But if you started with $12,000 of astro condensers and you still have $5,400 of astro condensers with you, you sold the rest, $6,600. Again, you can double check to see if this is correct. You sold 550. All of them are 12 bucks. So that adds up. Okay. This is also another beautiful illustration. I actually have this above my bed. It's really beautiful. So here's your average cost tank, right? All the money you spent divided by all the units you bought with that. There's your average cost per unit. And then it's just pretty simple. You have so many units left, multiplied by the cost per unit. That's your inventory value. And then cost of goods sold, you can either subtract the two like your book teaches you, or you can simply take the other 550 times the 12. You get to the same place. So this is a question, I'm going to start addressing what Hope was asking about. What should a company use? My answer is going to be two things, and it's both from Chapter 5. Chapter 5, we looked at the gross profit margin, and we also looked at the net profit margin. So you want the highest, I think, you want the highest gross profit and the highest net income shown to your stockholders. That's what makes them usually very happy. So Houston Electronics has a choice. They're not forced to use any specific method. They can choose their method of costing out their inventory. If I were Houston Electronics, I would advise them to use the FIFO method because it provides for the highest gross profit, which means that if you do a gross profit margin, it's going to be high. And it provides for the highest net income. So if you do a profit margin, it'll also be high. LIFO would not be a good fit because it produces a very small gross profit and even smaller net income. So using LIFO would mean this company would not look as profitable as it needs to be, and I don't think that's a good idea. Same thing with average cost. It produces a slightly lower gross profit and a slightly lower net income. Most companies will use FIFO. As you see, almost half of the companies use FIFO because when they actually go and buy their inventory, what they see is over that course of that period of time, that year, usually, every time they go and restock, it costs a little bit more. So FIFO is the best method to cost out if every time you restock your store, you're paying more for the inventory. So you're gonna cost out your early stuff, which is your cheapest stuff, and that's going to give you a bigger gross profit. LIFO, well, you got to think about what industries where every time they buy stuff, or most of the times when they go and keep buying stuff, the price actually goes down. So what comes to mind for me is large electronics firms, because once new technology hits, it's at its highest price. Okay, so whether it's a new laptop, a new cell phone, a new TV, whatever, the price is the highest. But what happens as the year or years go on is those prices really shrink quite a bit. And so for a Best Buy, maybe LIFO is the best choice of all the choices to use, because they probably would be paying less for their newest inventory than the older stuff, only because the older stuff was new and it cost a fortune. And now that it's gotten old, the newer prices are cheaper. So that would produce a better result for a company like that. Average cost is can be used by anybody, really. It's more common in manufacturing. So if you're making beer or you're making soda, you have your raw materials and stuff like that, and you're really going to go ahead and figure out what sugar cane went into every drink. I mean, please, it doesn't make any sense. Just average it all out and be done with it. So average cost may not be suitable for a lot of retailers, but it's certainly suitable for manufacturers for sure. Okay. And that's basically the big thing here. Oops, sorry. This is what you're going to spend most of your time on, is going to be the cost flow methods: FIFO, LIFO, average cost. So let's do it here. The do it exercise that's in your book. Cost flow methods here. So the accounting records of Shumway AG, so it's agricultural, show the following data. Beginning inventory. So they're starting with 4,000 units at $3. Purchases here, right? So your beginning inventory plus your purchases is the total. So they bought 6,000 at 4. So this is your totals right here. Your beginning inventory and your purchases, that's your total available inventory for sale. Right. Remember that chart we went over back in chapter 5. It's sort of coming back here, right? Beginning inventory plus your purchases gives you your total cost of goods available for sale. Then you split it, right, into either what's been sold and what's in inventory. Well, here they only give you sales. So they know whatever it is, 7,000 of these units have been sold. Okay. They want you to determine the cost of goods sold. There's actually only two questions you can answer with these cost flow methods. They're either going to answer what's the value of the ending inventory, which you saw displayed in those slides, or you can also answer what is the cost of goods sold, which you also saw displayed in those slides. Often when you get a homework question, they're going to ask you for one or the other. So pay attention. That's the real tricky part here. So here they want the cost of goods sold. They don't want the inventory. They don't want to know about the 3,000 units that you still have in inventory. They want to know about the 7,000 units you sold, cost of goods sold. So the focus is on that. Okay. So under FIFO means the first one's in. It's a short list. You got beginning inventory and purchases. It's a very short list to choose from. So first ones on the list are these 4,000. All of these 4,000 units were part of this sale. So you can say goodbye to those and the $12,000 that it cost you. You need another 3,000. So you need 3,000 of these units at 4,000. And so 4,000 units plus 3,000 units gives you your 7,000 units. It just so happens that both the beginning inventory and the purchases are valued at 12,000 each, because 3,000 at 4 is 12, like 4,003 is 12. So the cost of goods sold for FIFO would be 24 grand. Okay. It could be just that easy. And remember, we're doing this for an agricultural company, so there's got to be some way of figuring this stuff out. I need a drink. Sorry. See, that's why cats love this stuff. LIFO, same problem, but how would they determine the cost of goods sold if they use LIFO? Well, again, they sold 7,000 units. We don't care what the price they sold it at. We're not calculating revenue. We're calculating cost of goods sold. Which 7,000 did they sell if they use LIFO? Well, LIFO is last one's in, first one's out. So all 6,000 units of the purchases have been sold. And we need 1,000 more of these to complete the 7,000. So 6,000 at 4, 1,000 at 3. And when you compute that, you'll get $27,000 as the cost of goods sold using the LIFO method. Woo-hoo. Well, there must be some way to do the average cost. Yes, it's a little bit more entailed because now we have to do a few things. For example, we have to total up how much our inventory was worth. So that's the beginning inventory of 12,000, 4,003, plus the purchases 6,000 at 4. Total those up. So we bought $36,000 worth of whatever this of something. Whatever the something is, we bought $36,000 worth of it. It bought us 10,000 units. $36,000 divided into 10,000 units will give us an average cost of $3.60 per unit. And there's a couple of ways to solve it. You sold 7,000 of them, so 7,000 times 360 will get you your answer. Your book, as you know, says, okay, if you started with 36,000 worth of inventory and you have ending inventory of, then you have the rest is cost of goods sold. There's a couple of ways to do it. They're both fine. That's what you're going to be spending most of your time on this week. So you will be spending some time on this. Anyway, questions?